Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Next up, the Planet MicroCap Showcase Vegas, happening April 30 through May 2nd, 2024 at the Paris Hotel and Casino. Save this date. We are working our tail off behind the scenes to put together the best program we can. Some really, really cool conversations with incredible thought leaders. The website is now live. And if you'd like to register to participate, please visit planetmicrocapshowcase.com. See you in Vegas. Now, my guest on the show today is Filip Erhardt, founder and CEO of ESGFIRE. I was introduced to Filip by Paul Andreola from Small Cap Discoveries. Thank you, Paul. A few months ago, and we had a phenomenal conversation about his ESG strategy and his approach to investing in environmentally friendly companies. In the summer 2023 issue of the Planet MicroCap Review Magazine, Filip contributed an article titled ESG Investing 101, documenting his investing process. And you know what? I thought it was time to invite him on the podcast to dive deeper into ESG, Cleantech, Agrotech, and why ESG is still a megatrend that investors shouldn't ignore. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my interview with Filip Erhardt. Filip, thank you for joining me today. How you doing, man?
Thank you, Robbie. I'm fine, thanks. How are you?
Oh, just we're on very different ends of the timing here. I'm being in LA, and you're in Denmark, right? Or
Sweden?
Pretty
close,
yes.
Almost. Yeah.
So we're making it work here early in the morning for me here, and it's pretty much end of day for you. But I do appreciate you taking the time here. And by the way, shout out to Paul Andreola for connecting us. He, when I reached out to him, I was like, we've done a little ESG on the podcast here. I've spoken with a few investors that have an ESG focus. We didn't talk too much about performance. A lot of those times it was, kind of the 101 type stuff. But there's so many different ways to kind of quote unquote attack this ESG strategy. And I wanted to have you on because when you go right onto the ESGFIRE website, it's right there in your face that since 2018, ESGFIRE has had 1,100% returns with an investing strategy focused on ESG, specifically environmentally friendly companies. So, I kind of want to start there, specifically with your background.
Absolutely.
Tell us a little bit how you got your start in investing and how you arrived to having this ESG focus.
Absolutely. So, I've been investing in the stock market for the better part of, probably 20 years. I'm 36. I started when I was 16, and the reason I came up with ESGFIRE was that I wanted to find, a mega trend to invest in back in 2018. And I'm a long-term investor. I'm not a trader. I'm not not even a swing trader. So I really wanted to find something which was going to be in a major growth for a long period of time. So I identified ESG and specifically Cleantech as, a mega trend which had been going for a long period of time. And, I thought it was going to be pretty likely that for the next 20 or 30 years, it would be increasingly growing due to, climate change, regulatory, and also due to the fact that if this planet is going to survive, we're going to have to start looking how to mitigate the climate effects that are taking place right now. And I just want to add too that I wanted to invest in something which would, not just be profitable, because I wanted to be able to feel good about it and to actually be able to stand behind it. And I've seen a lot of self-proclaimed gurus, preaching about people becoming financially free either by using dividend stocks or, even going as far as people acting like con artists with pump and dump shows. And I wanted to show people that there's actually a way to reach, financial freedom using Cleantech stocks. So that's essentially how ESGFIRE came to life. And that's where the fire comes into the ESGFIRE, because some people might not understand, the reason for the name. So I'm happy to be able to to clarify the background.
No, fair enough. And I so appreciate that. So like when we're talking about your ESG strategy, and we'll get into your full criteria in a minute, but just overarching, it sounds like the main focus when it comes to the ESG side is on the E, on the environmental side. Like that's really it's the first letter in ESG. Sounds like that's by far the primary, most important focus. So tell us a little bit more there.
Yeah, ESG stands for, like you said, environmental, social governance. And the problem a little bit with the ESG concept is that it's gotten lately a little bit of a bad reputation because ESG ratings per se have not been that good in identifying performances based on sustainability and actually what carbon footprints being done. And that's the reason that some companies like Facebook or even tobacco companies can get a good ESG rating because, they're ticking all the boxes of an ESG rating, but that doesn't mean that they're either sustainable or even good for the climate. So the major problem has been that a lot of Cleantech stocks have gotten into the negative side of the chatter because the ESG ratings used by major funds and indexes is completely crazy, to be honest.
By the way, are you a shareholder in Facebook?
No, I'm not a shareholder in Facebook. Apologies, no.
Compliance Bob, just making sure. But that's interesting that you bring that up. And I know we're going off on a little bit of a tangent, but it almost seems like kind of an opportunity, at least from your perspective, because you're saying, okay, these Cleantech stocks are just not getting the re-rating they probably deserve because they're, these nebulous scores are basically saying that they're not what they say they're trying to do in some respects. Yeah. Is that what you're saying?
Exactly. And another sad part of this is that since we have, we have a macro situation right now where stocks have been battered and especially, I would say, small cap and ESG stocks have been crazily hammered relentlessly. And, there are two reasons for that. One is the overall hammering of stocks in general. And the second is that a lot of these ESG companies are either not profitable or have been trading on really high valuation multiples. But I would say that the best time to invest in Cleantech stocks is now, because I've seen valuations. I'm not going to mention specific stocks for compliance reasons, but I can just say sector-wise, I'm seeing solar power, wind power, generating companies that used to trade for like price to earning 30 are down to like 15, 17. And these are companies with really, really big growth numbers. So, if you just take a quick look at these sectors, you're gonna find huge opportunities right now.
Do you think that some of those names also right now are kind of in that place of like, oh no, please wait, we're not an ESG company. No, we're Cleantech. We're Cleantech. Stop. No, we're not
yeah,
ESG.
That could be it. Yeah, that could be it. But I don't think ESG as a word or as a concept is going to go away. No, but the problem for ESG as overall has been that it's not been defined what ESG is. That is the major problem with the sort of the wording itself.
Do you think it ever will though?
No.
Yeah, no. Right? Like
because
there's no
regulation. So it's just as crazy as, back over here in Europe, basically anyone can call themselves an attorney. It's not a protected title. Yeah, it's not a protected title. So, a lawyer is a protected title, but an attorney is not a protected title. So that's the same problem, that if you don't have a clear definition or regulation to define something, everybody's going to have their own opinion about it.
Absolutely. One, it makes it makes it interesting for podcast content for sure.
Oh yeah, for
right?
sure, for sure.
A lot of different
Yeah,
opinions on ESG. Because especially back in 2020 when I did my first ESG real focus type interview, it was really trying to understand that balance between like the E, the S, and the G. And that was where I think we all started. It's like, well, what does the balance look like?
yeah,
Trying to better understand using Tesla as an example, because I think that was the one that everybody was like, oh, this is a clear issue. Like, is it really, when you think about all the stuff that you need in order to create the battery, all that kind of and like
yeah.
that's where the conversation at least kind of got started. And it seems like, especially right now in 2023, when has been more a reversion to fundamentals and valuation, like I think that's also where there is a bit of a miscommunication, because there's a majority, especially in small microcap, of some of these clean tech ESG names that are pre-revenue, not profitable, but there are some that are kind of starting to get there, right? Or
Yeah.
at least
Yeah.
they're fully funded and they don't have to go and do these egregious capital raises. So, by the way, I'm not a shareholder in Tesla, nor do I own a Tesla car. But going from that point, now I want to kind of get to your criteria itself when you're looking at a potential investment that's an ESG idea and or clean tech, whatnot. So can you go through some of your criteria that you're looking for in a potential investment?
Absolutely. But before that, I'm gonna say something controversial. And yes, no, I'm not a shareholder in Tesla. Yeah, but
love controversy.
Tesla,
Let's go.
yeah, Tesla for me is not a clean tech company. Tesla have not been successful in, at least so far, not in identifying, a sustainable source for their materials and the production of their cars. And if you actually compare the amount of resources and energy required to make a Tesla car, you're going to have to drive that car for, an incredibly extreme mileage for it to make sense from an environmental perspective. That's why personally, I drive a hybrid, because a hybrid car doesn't require the same amount of energy and resources to be produced as an fully electric vehicle. And, they've even had other issues. I'm not going to go into details, but I've never been a shareholder in Tesla, nor do I think I ever will be, because creating a vehicle mass produced for the public, price competitive, you got to cut so many corners to get there. That's the problem.
For sure. And by the way, I don't think that's as controversial as you think. I think there's quite a few, not just ESG investors, but folks that, where the argument's trying to be made that it's an ESG stock, would all like, are you sure about that? Like, it has ESG elements, but with fully electric car and everything. But when you actually dig into the nitty gritty, I think we can all agree. But I mean, that's a problem for all fully electric cars too. It's not just a Tesla problem, right? It's getting all the material in order to make a fully electric car, which, hey, we hope one day that, that part of the supply chain figures itself out and becomes environmentally friendly. We all want that. It's not like we're here just wanting to poo-poo it. We want to see that work. But I agree, man. I've been looking at
the major problem is the battery, because the battery is what takes most resources, and batteries today have not, in my opinion, reached the point where they make sense to put into cars. I mean, they need to get more energy efficient, less resource consuming. That's the biggest problem. Batteries are great for battery storage, power storage, for renewables. Awesome. That's a great way to use them. But so let's get into the criteria anyway. So there was like really no clear definition of ESG investing when I started back in 2018. So that's why I decided to create my own. So in ESGFIRE's opinion, a company essentially, has to be either environmentally friendly as a product or a service to even be considered for us investing. And we focus mainly on small cap and micro cap. So that's typically companies at below $100 million in market cap. And the major reason for that is that the strategy is based on finding high potential companies in early stages. So we want to maximize our potential returns during the expected growth journey. And the other reason is pretty simple, because these companies generally aren't covered by any other firm or analyst or anything. So the chances of finding something mispriced is considerably higher. So looking at the main scope, I would say we've had to change our strategy a little bit over the past 18 months. So we're putting a bigger emphasis now on companies that either are close to being break even or being profitable. So except for being in a friendly, like environmentally friendly product or service, if it's not profitable, we're going to need something else. For example, a higher moat or a uniqueness for us to become interested. Like, say there's a company that has an invention which they are alone with on the market. They have, plenty of patents. They're not profitable, but, we know there's a high demand for their product. And assuming that the company's market cap is in an attractive place and they're not in a bad situation regarding financing, they could still be of interest, but it has to be something unique. So to sum it up a little bit, I would say that environmentally friendly business or service, unique product offering or service with a strong IP and/or patents, profitable or near profitable. And then we have, we look at management, needs to be a solid management and preferably with a high level of insider ownership. We look a lot at sustainable production methods, referring back to Tesla, which we're not shareholders in. Investor-friendly management team, and there's, if they have recurring revenues, that's a big plus. It doesn't have to be that a company fits all of these criteria, but they should fit the majority of them.
For sure. And dude, thank you for going through all of that. Because look, the number one thing I think everybody listening to is like, Filip, sounds great, right? Like, you know what I'm saying? Like, Agtech, Cleantech business that's break even, profitable, near term, like that. Wow. Like, point me in the direction, So, like, what types of businesses in the Agtech and Cleantech space have you seen that have been break even, profitable? I'm saying that carefully because I know we want to be careful about specific names. So, what businesses have you seen that have actually gotten there?
Well, I can mention a company
and 100 million in market capital. Yeah.
Well, I can mention a company. They're not a client, but we are shareholders. So I can mention a company that they're not profitable, but they have a lot of orders which should make them profitable shortly. And it's a Swedish company in the last mile delivery field called Clean Motion. And it's a very tiny company. But it is a major position for us because I've followed the company for many years now, and I recently, and when I say recently, it's about a year ago, decided to take a position in the company. And they have a really, really cool product. They got solar powered roofs on these vehicles. It's only on 3 wheels, which saves energy and maximizes range for the vehicle itself. And it's extremely cheap and cost effective. So that's just an example, because there are a lot of last mile delivery electric vehicle companies that have not gone so well, especially in the US with all the SPAC listings and IPOs. But this company really is onto something. And, they recently signed a framework agreement to a really prestigious project called NEOM in the Middle East. And we really think that, if they get traction on this thing, it could be huge.
Absolutely. And that's an interesting example. I don't know the company very well at all. I'm not a shareholder, but the reason that I also was interested in that, because it hits on a main thing that I think a lot of investors have been burned by in the US and Canada here is basically that, there might be, an ag tech or a clean tech company that has a great IP, great invention, like has some kind of technology that can revolutionize a big problem. But then therein lies the problem, is that they're trying to solve a big problem, which requires a lot of capital, a lot of follow-up.
And this example I just gave you have been able to develop their product with extremely limited financing. And I also believe, bootstrapping essentially. So I can tell you that it's not always positive to have a lot of cash because it makes you sloppy and lazy, in my opinion. So for a lot of these companies, they probably would have been better off, these SPAC companies by not having so much money, because they would have needed to be more efficient and smarter in their way of development. And I can say, like Arrival, for example, is one of those listed companies, not a shareholder, never been a shareholder, but, it's just a shit show, really, essentially. Forgive my language. But, there are a lot of examples of these type of companies that have had big plans, but the problem has been that they have not started with what the demand actually is. And what Clean Motion did was they began looking at, okay, what's the demand? Like, what are clients asking for? So they started, instead of saying, oh, we have a great product, let's see if somebody wants to buy it. Instead they went out and say, okay, what's the actual demand? Like, what's the demand on the market for these type of vehicles? What are the features? What price range is attractive? So I believe a lot of these companies, they never get over what is called the chasm of doom, which is essentially, going from early adopters to major sales. Like, they might get a few trials out, they might get a few early adopters. I'll mention another great example, Solo, not a shareholder. It's called Solo is the ticker. Electromechanica vehicles, awesome, cool idea, like 3-wheeled personal vehicle for one person for commuting and stuff, but hasn't taken off, So I think that's a good point to make. I hope that answers your question.
No, it does, man. And I mean, because I think, when we talk about, where traditional ESG investors have taken the wrong turn, you mentioned this in the article that you just did for Planet MicroCap Review, which was ESG Investing 101. And on one hand, it's like, yes, the credit agency or whatever, I don't even know if it's credit agency, the rating agency, the ESG rating agency, just misunderstanding where there are real ESG opportunities just because these rating agencies may have gotten something wrong. But at the other hand, it's just the sentiment around some of these companies, especially in the microcap, small cap range, where, they just, they'll prove the tech and the tech might work, but then they just get flush with cash and then they're just not sure really what to do. And really it's all about just, it would be better for the industry or just ESG as a whole if there was more of an emphasis on some of these companies that kind of bootstrap things and are, trying to build real businesses versus just having cool tech.
Exactly. And there is a lot of garbage out there. I mean, I do want to mention a word of caution for people listening to this, that you have to be really careful looking at companies in this small market cap size, because, there are a lot of bad investments out there. So really, really be careful and look at what type of selection criteria is that you're employing. But I'll say one thing that doesn't scare ESGFIRE looking at companies, a lot of investors might not take a look at a company because the stock price has gone down, by tremendous amounts. I mean, to me, that's pretty irrelevant. What's relevant for me is, has the story changed? What was the reason that the stock tanked? Like, going into a company that might have transformed, going in a completely different direction. And to mention one company, both that were major shareholders and clients of us, just me to disclose that, they're in agriculture, called Replenish Nutrients. And, if you look at the stock chart, you would probably think, well, this is probably a shit show. But when you look closer at it, you'll see that the company is transformed from sort of the basic development company into actually a revenue generating company that actually has a really cool path to closing in on 40 million revenues and licensing opportunities. And the company's trading at like $8 million market cap. So, there are a lot of opportunities if you are vigilant and if you have the patience to look at the background of these companies.
Absolutely. So for you, how do you build, okay, you have your criteria. This is what you're really looking for. How do you build your ESG, I guess your portfolio? Like, all right, this is when I'm going to take a starter position, and this is as how I'm going to really build size into it. So love to hear more there.
So we employ a 70-30% strategy, which means 70% are public companies and 30% are non-public companies. And the non-public companies are usually between 12 to 24 months away from an IPO. We try to spread out our investments across various sectors. We rarely have more than one company in each sector. And we try to have a good diversification between, for example, electric vehicles, commodity companies, ag tech, and such and such. So it really has a sound risk management coming to diversification.
Got it. And then, what are some of your criteria for selling as well? Like I basically is a change in thesis that's.
I'm glad you asked.
Yes.
Yeah, I'm glad you asked. Surprisingly, I rarely get that question, but it's a very good question. So, a few reasons for us to be selling something is either management consistently not delivering on promise and not delivering on their forecast. Anyone can have a bad Q report, like a quarterly report, but if it's consistently below our expectations, or if from the management is consistently promising results that are not showing, that is definitely a reason for us selling. A more rare reason might be that there is a major technological breakthrough which might make an invention for a portfolio company obsolete. Has not happened more than once, but it has happened. Major financing risks, associated with certain positions, where I feel, the company may have a very hard time finding funding. And last but not least, unexplainable major insider selling is definitely another reason for selling a position.
For sure.
Yeah.
Listen, man, you're applying. You basically have a value strategy for ESG, right? Let's.
It's value investing. Yeah, exactly. It's value investing in ESG, definitely. I'll be 100% transparent about that.
That'll be the title, I think, of this pod for today. Apply a value investing formula to ESG. So okay, we've talked. Obviously, for your strategy, it's mostly a focus on the E. Clearly, like that's the bar none. Like focusing on companies that have some kind of tech or something that is helping to reduce our carbon footprint. That, bare bones, right there. But then it's ESGFIRE. There's an S&G in there. So love to hear your thoughts on how you think about, the social impact as well as the governance impact when you're looking at these potential investments.
Yeah, absolutely. I take a great pride in the fact that we give out all our research for free. So, we try to be very transparent. We are 100% transparent. Anytime we sell something, anytime we buy something, it's disclosed. Our newsletter it's free of charge, and anytime something happens in our portfolio, we're being transparent about it. So we're trying to have very high standards for our own governance, so we can set a good example. But I would say that sustainability and regulation governance are two major things that are overlooked. And what I mean by that is, we have this example in the article with you guys, and I think it's very good to bring it up. There was a company in Germany called Wirecard that was a fintech company in payment services. They essentially had frauded and tricked the whole stock market that they had made major profits. And it turned out that the entire profits of the company, 2 billion euros, was just fake, thin air, didn't exist. Germany is not such a bad country when it comes to regulations, but the problem was that the company had been, I call it, massaging regulatories, assuring them that everything was fine. They had shorters calling this bluff out 4 years before it actually hit the fan. And these shorters were attacked by the authorities. So, what they got for trying to call this out was that they're being, subpoenaed by the courts for trash talk, basically. So I think there is a big discrepancy, and probably still there was, and there still is a big discrepancy between regulatory standards and, how companies actually are reporting. I'm not saying there are frauds around every corner, but you need to be careful. If this wasn't discovered for several years, and this was a pretty big company also, this wasn't a small cap company. You could have accounting frauds in considerably smaller varieties as well. Speaking of the S of ESG, we've talked a bit about it. It's about the social part, taking social responsibility. I think it's really important to look at the whole production and value cycle of companies. I can mention a company, not a shareholder, H&M, terrible social responsibility structure. Up until recently, anyway. It's a Swedish company. I mean, I would have loved to say I'm proud of it, but I can't say I am, because they've had so many issues with child labor and stuff like that. So, you have to really, when you invest, or when we invest rather, we don't just look at, oh wow, great, this is an environmentally friendly product. Well, how did the product come to life? Where's the material coming from? Have they sourced where their raw materials are coming from? How's the production method? Are they using, environmentally friendly production methods, or are they simply using whatever is cheapest to get whatever they need? That's one thing that we also look very closely at, which I think is overlooked.
And then, because it also seems like the S has been the social aspect has also been merging with the idea of what is the company's culture as well, right?
Yeah,
exactly. Which tends to blend in with governance too, in many respects. But then also just looking at the company's culture, like, is this what kind of environment are your employees like? Are they happy to be there? Is there do they like to represent your company? Are they happy about what they're doing? Do they believe that they're doing something good? A lot of these things are important as well. 100%. And then, because it's interesting when you bring up that point on the social aspect of like, all right, well, how did this product now come to be? And I think that's something that maybe some folks that potentially want to adopt an ESG strategy are also like, okay, that's great. They might be, God forbid, we don't want them doing child labor or anything like that. But, we also want efficiency, too. So there's a balancing act between like the company saying, all right, well, we want to operate this company efficiently, but we also want to make sure that we're, sourcing all our materials from the most, environmentally friendly or places, right? So love to hear your thoughts on that balancing act for some of these companies and where you lay on that spectrum.
For me, profit never goes before sustainability. So if it's a company that, even if it's a very good valuation, if I find out that they're using environmentally unfriendly methods, like, for example, cyanide when it comes to mineral production or mineral resourcing, or simply that they're using harmful methods in other aspects, that goes away without a blink. I can't. We don't want to have companies that can question our integrity. That's the main point of focus. So, might sound strange to investors that making a profit is not always number one, but I've adopted this strategy for a reason, and that's because I want to be able to put my name behind it and never feel that I have to justify any decisions that we make regarding our investments. So that's just how we work,
dude. And especially like using that example, like that's a risk factor at the end of the day, right? Like that company,
for sure.
Like anybody that might, let's say that we were doing a bull and bear case where, there was the mega bull on one side. Let's say you were the bear of that company, despite seeing it profitable. Like that becomes an easy no-brainer. Like, well, do you see how they're producing these nutrients? They're using cyanide, they're using this, they're using that. And
what happens if that comes out like a major news for their clients? They might lose all their clients like that from one day to another, which I have seen happen to certain companies. So it's a very, very big risk, even if you don't think it's important from, an environmental aspect, but it can also affect your investment in many other unpleasant ways if you are not careful. So it's definitely a concern to be dealt with.
And also now, like, that's something like, these types of concerns and this type of, grassroots journalism looking into some of these companies, that's not going away.
No,
at all.
Probably just going to be more increase in that.
Exactly. So, even if there's a company that's like right there on the spectrum, or something that maybe people have thought there was some questionable practices as to how they produce their product, like it will come out. Like it's not it's not a matter of if, it's more of a matter of when.
Absolutely. And I actually want to lift one interesting aspect when we're talking about this, because I'm a huge fan of electric vehicles, I have to say. I mean, like, I really like the concept. No doubt. No, but there are other transitions that I believe we need to make before they actually can be put to use on a major scale. And I think it's worth mentioning. And, this is both a client and a portfolio company of ours, but they're pretty unique in the sense that it's a pretty small family-owned company based out of Italy called Landi Renzo, which are both really successful in natural gas and LPG engines, but also into hydrogen. And I think that before we reach the point where electric vehicles will be able to take over from combustion engines completely, we're going to see a transition period where, gasified or hydrogen run engines will probably be the transition. Because when you look at the calculations, how much energy is going to require to make all combustion engine cars go away, we would need so many nuclear plants in Europe alone to make that work, which is just, I don't know how they're going to do it, to be honest.
I think that's a very practical approach to thinking about this. And also, like, I think people will probably breathe a sigh of relief of like, oh, cool. Like, there's an ESG investor out there that doesn't think that we need to completely flip everything tomorrow. And that's how it has to be, because practically.
Sorry, just one correction. They're not a client. They're just a portfolio company. Apologies for that. I made a mistake there.
No apologies. You're good. No, you disclosed it. You're all good.
Yeah. So, I mean, we have 12 different companies in the portfolio. So, you have to keep all those in mind, who are clients and who are not clients. So that might be.
No doubt. And for those that, just to better understand the ESGFIRE business, on one hand, you guys have portfolio companies that you invest in, but then you also help a few of these companies with some IR stuff, everything like that. Just
basically marketing. Yeah, basically marketing. So, and the good thing to keep in mind here is that we don't take on any clients. I mean, they have to go through the same rigorous selection process as any other portfolio company. And we don't work with more than a handful of companies as clients, because we don't want to take in companies that we wouldn't invest in otherwise. So any company which is also a client would first have to be eligible for being an investment case. That's basically it. That's a big difference between us and other services in that area.
Absolutely. No, just wanted to clear that up. And also,
that's great. Yeah.
I'm a big fan of that model. I think that's if you're going to be in that space, like you want to talk about companies that you're actually investing, that you have skin in the game, right?
Yeah, exactly. Yeah, not just like an analyst who takes a paycheck and just writes an article. We actually put our money where our mouth is.
Very cool. All right, so I think we've covered quite a bit on not just your strategy when it comes to ESG, but ESG in general. But I guess maybe this might not be my final question, but as a whole, the way you kind of see ESG investing right now, recording this on November 1st, 2023, what do you think is the sentiment right now, and how do you think it changes?
Yeah. So I would say that, looking at the sentiment for ESG right now, is that your question, to be clear? Yeah. Well, right now, I think it's an overall, unfortunately, a little bit negative sentiment, but it has to do with the fact that stocks overall are under pressure right now because of the interest rates that we've seen. So our theory is that interest rates have probably peaked, where they may remain high for some time. I would guess, another 12 to 18 months, but at least, we don't foresee any higher rates putting further pressure on the stock market. There may be other factors at play that could potentially pressure stocks, geopolitical events or unexpected or increased armed conflicts around the globe. They might affect supply chains and commodities. But like I said in the beginning here, I think there's probably not been a better time to invest in ESG stocks than right now, because valuations have taken an unjustified turn for the worst. So, there's a saying that is the best time to invest was yesterday, the second best is today. So, and I would say that really applies to ESG stocks at this point. But like I said before, you got to be careful in the selection process. You can't just pick anything. And if you feel not competent enough to pick your own stocks, I mean, look at ESG funds, but be careful what their selection criteria are. Make sure that the fund actually invests based on environmental friendly aspect, not just ESG ratings, because like we've discussed, ESG ratings as a whole is not a guarantee for getting cleantech stocks for sure. And obviously, sign up for our newsletter.
That's a great place to end it, Filip. Thank you so much. Where can our audience go and find more information on ESGFIRE, as well as follow you on social media?
Yeah, so ESGFIRE.com is our website, and ESGFIRE is also our handle on Twitter.
Very good. Well, Filip, thank you so much for joining me, man. Really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
So do I. Thank you.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.